So good morning and welcome everybody. Thank you for joining us. Um, this is a panel discussion on digital infrastructure. Um, really like to thank the private markets group for arranging this and allowing access for everybody joining online today as part of a wider family office forum throughout the day. I'll start by introducing myself. I'm Stuart Pennington, Global Head of Asset Owners, which is institutional investors, family offices, and LPs at IQEQ. We're a financial services group. Perhaps I'll introduce my colleagues. First, starting with Mark. Mark, perhaps you'd like to introduce yourself and your background.
Yeah, thank you, Stuart. My name is Mark Gansey. I'm the founder and chief executive officer of DigitalBridge. We are an alternative asset manager with offices in Singapore, London, New York, and South Florida. We manage about 122 billion of assets globally. We've been building digital infrastructure since the early 1990s. So one of the pioneers in the space, and today are super focused on delivering AI infrastructure solutions for our customers on a global basis.
Thank you, Mark. And apologies, I should have gone ladies first. So Maria, perhaps you'd like to introduce yourself as well.
Not an issue at all, Stuart. Happy to. Maria Aguilar-Wittmann, I'm co-heading the strategy, infrastructure funds, co-investments, and secondaries at Allianz Global Investors. And Allianz Global Investors, we're a global asset manager representing institutional, but also other professional and semi-professional investors in the space. We manage across private markets over 100 billion in terms of AUM. 50% of that roughly is in infrastructure, making us one of the largest European asset managers for infrastructure. And a significant portion of that we have deployed to date in digital infrastructure. So for us, very happy to be here and discuss the space.
Fantastic. Thank you. And thank you both for joining. I think I wanted to sort of just set the scene for everyone. In my role, looking at particularly dealing with family offices, we've seen a move from the family offices as LPs and investors moving away from more traditional markets into private markets. There's always been an understanding of the sort of real assets and real estate market, but we've started to see more interest and more investment into infrastructure. Now, with our burgeoning tech lifestyle, the interest in digital infrastructure, digital assets, AI increases. UBS recently carried out a study where family offices were extremely keen to build their experience and understanding of this space and start to invest more. So really with the panel we've got today, we've got a sort of representative of a manager, general partner, and a investor side, but we've also got an LP, a very key LP in the space. So I think we're in an ideal position today to talk about some of the themes, sort of both from GP and LP perspective, and try and bring in some detail around the nature of the assets, what's happening in the market, methods of entry to the market, and some of the risks associated with it. So really through this today, we're going to look at kind of touch on three key themes: investment approach, market opportunity, site selection and the issues around that, and market risks valuation and the portfolios. We've also received some questions ahead of this session, which we'll try to address if we've got time. So if I could kick off, I think, Maria, maybe I can start with you. Just generally, private markets and even outside of this space, 24-25 have been a challenging time for raising funds and entry into markets. What have you seen, and sorry, for both of you, what have you seen for fundraising and for the investment market in digital infrastructure? How have you seen the last couple of years?
Yep. No, happy to start with that, Stuart. I mean, I think, what we've seen despite the backdrop that you mentioned, right, on fundraising as a whole, that actually a lot of that amount that it was raised, at least full year numbers that I have available, 2024, has actually gone to data center funds. So data center funds, at least in 2024, captured almost 50%, around 45% of capital raised globally, which reflects AI demand, as Mark alluded to in his intro. And I think that is massive. That's quite material. I haven't seen the 2025 numbers yet, but I think those could be expected to be maintained. And when I think about what's coming, 2026 and onwards, that could still very much likely be a very significant portion of capital that is raised in the market. Maybe also, not just specifically data centers or AI, but maybe like data centers together with on-site generation or some sort of energy, kind of combinations that we're seeing in the market. But definitely, surprisingly, also given the backdrop, how much that is capturing.
Okay. And Mark, sort of stateside for you, as your organization, obviously, you're outgrowing. How have you seen the last couple of years? Challenging or with your scale? I guess it's been positive.
Yeah, I think the fundraising environment was generally pretty good this past year. It's been generally pretty good for the last 5 years. There's been a really good tailwind around AI infrastructure in general. I think the thematics that investors want to know is they want to be invested in platforms that have scale. They want access to co-invest. They want to certainly understand, what is the structure of the vehicle, whether it's open-ended or closed-ended, or it's a continuation fund, or it's a straight co-investment. So we have a pretty tailored product for all our clients so they can get access to all of those things. And so really it's become about, where do you want to take that geographic risk? Who do you want to, what types of data centers do you want to be involved in? And then more importantly, what's your liquidity window? And so based on that, we've had a pretty good access to capital markets and access to equity and fundraising. And so this past year, we raised, between debt and equity, we raised about 23 billion. And the year previous to that, we raised about 29 billion in sort of debt and equity. And that was really to fuel, very few new platforms, but really tacking on to existing businesses that have had success and that have had the ability to grow in their existing campus footprint or grow outside of those footprints. Another area that Maria touched on that's really important is on-prem generation. That's something that we've been doing for a couple of years now. So we now have a dedicated strategy that is focused exactly on that, which is grid independent power. And so we're doing, roughly 12 projects in flight now. We've already built 4, but there's a real emphasis to build self-generation capabilities that are tethered to the grid so that you can trade equally in the grid. And this way you're not taking away from baseload, which is a critical metric that the regulators are using now in terms of deciding whether or not you get power. Power is the key commodity. I wouldn't be so brazen to say capital is probably second, power is first, but the ability to actually have a delivery date on power is the currency at which you are successful in terms of getting the right leases with the right customers.
Mark, just picking up on sort of your ability to raise over the last couple of years being strong. Have you seen a change in your, I guess, the investor base? Obviously, you've got the kind of core institutional investors like Maria, but have you seen a move or into family offices and a sort of more interest in the sort of the less institutional style investor?
I would say, go back 13 years to the inception of the firm, and we were principally all family office capital. So
yeah.
Family offices are really what put DigitalBridge on the map. So we had a core group of about 25 family offices that backed myself and Ben Jenkins that had known us over the last 30 years and then successfully invested, either Ben at Blackstone or myself in the various businesses that I built. So the inception of the firm traces its roots to really working with family offices that I think understand risk and have a little bit more entrepreneurial spirit in them. And so we migrated upstream into institutional capital. And I would say today, 97% of our capital is institutional, 3% is family office money. We don't count private wealth distribution as family office money. We sort of bifurcate that. So if a family office engages with us directly, that's family office capital. If we're working through an aggregator like a UBS or a Goldman or Citi's private wealth platforms, that we call that private wealth. It's different than family offices. Our family offices typically write anywhere from 5 million to upwards of 50 million. We've had a couple of family offices write $100 million tickets into deals. And so we find that those organizations are pretty sophisticated and they're not using a conduit in which to invest. So we bifurcate private wealth and family office capital. But fortunately for us, we've taken capital, geographically all over the world, different institutions. And from a geographic perspective, we're actually pretty balanced. Roughly about 18% of our capital comes from Asia. Over 32% of our capital comes from the US. And the balance is split pretty evenly between Europe and the Middle East.
Okay. And Maria, just sort of closing up on that, obviously in your role and as such a large scale institutional investor, how does the digital infrastructure fit within the general infrastructure investment strategy of your organization? Do you see it as a growing part, or is it and certainly over the next few years, is it going to, I guess, become more integral to your overall investment strategy? Sorry, I lost you for a second, Maria.
Oh, hi. Sorry, I'm having, I think, some IT issues. Could you repeat the question? Apologies.
Sure. No. I was saying as such a large institutional investor, how does digital infrastructure fit within your kind of global infrastructure investment strategy? Is it you see it really increasing over the next few years, or how does it form as a percentage of your overall investment strategy of your team?
I think for the portfolio that I manage, sorry, the indirect kind of equity portfolio, it is very material allocation within what we see, again, across geographies and subsectors of digital. But I would say, it can be around a third or so of our kind of indirect exposure into infrastructure that is really linked through the different ways you can get into the space, right? So we'll maybe get into that, funds, co-investments, secondaries, but through all of them, adding up to roughly a third of the portfolio.
Got it. Okay. Maybe if we move on to sort of the market conditions and what we're seeing in the space. As an investor, I guess both sides, but what are the key considerations you'd have for sort of entering the space before you start to allocate capital to digital infrastructure? I don't know who'd like to take that first. You both come at it from slightly different perspectives, so maybe we'll start with Maria.
I'm happy to start. I think it's terms of, I guess, what the existing. I mean, if you're really early entrant into the sector, I mean, what are your?
Yeah, we kind of. I lost you for a second there, Maria. It keeps sort of dropping. Sorry.
Answer first.
Please. Thank you.
But
Thanks.
The evaluation of digital infrastructure, partners is, I think first and foremost, it is a specialized form of infrastructure, because you have to have an understanding of technology and you have to have an understanding of real estate. Digital infrastructure is one of those unique asset classes where you marry investing in telecom and investing in real estate at the same time. A lot of the underlying principles, Stuart, in digital infrastructure involve land use, permitting, power requirements, title work. These are core principles to real estate. And at the same time, from an infrastructure perspective, to tick the boxes from an infrastructure perspective, you want to make sure that you understand how to create that strategic moat, how to get that unique permitting, how to get that long-term contract that creates, 10, 15, 25 years of cash flows. And so picking a partner in that is, you certainly want to know that someone's done it before, that they have operational experience, and that they understand how to operate the asset, because it's not a toll road. It's not a utility in the sense of a transmission line. It is active infrastructure. in the sense that there is live compute going on, or there's a radio signal going on, or there's optical light traveling through a cable. This infrastructure requires a certain set of specialized skills. And most importantly, the customers have to trust you. So it's really hard for someone to hang a shingle and say, walk into Amazon's door and say, hi, I'm an investor and I want to build you a data center. Amazon's going to say, that's nice. There's 400 other people that want to build us data centers. They really want to work with people that they know have delivered compute for them for decades. And so the customer angle is super important. Being validated by customers, and having done it for 32 years, we understand the language of working with customers and why their network is so important, and not just the data center, but understanding the fiber connectivity, the power, and all of the underlying components that are required to orchestrate making their infrastructure work without any interruption. Downtime is the worst word in digital infrastructure. So having no downtime and having perfect connectivity is critical.
Mm-hmm. I would add to what Mark said on operational KPIs, and as well, we do, of course, want to support platforms that and also GPs that have built those relationships with, I guess, if you're looking at hyperscale, those key hyperscale customers. But I mean, maybe the overlay that I can add here on the LP side is, of course, what are the assumptions in the base case that we see, right? Of course, it comes to two things that we really focus on for us is, kind of cap rate assumptions at exit. Like, what are you assuming? Are you assuming that, current land and power constraints will stay the same throughout your entire hold? Or, are you trying to maybe build some additional comfort there, which we would expect to see in the business cases that we're supporting? And second, what type of, what size, what is the ambition of the platform that you're supporting? How big will this be at exit? And based on, the 2x MOIC or similar that you may be envisioning, is this too large to exit in one go? Or what is actually a feasible plan to, once you've been successful building such a platform, to really create liquidity for LPs?
Yeah, I think that comment you made, Mark, about the expertise and the team makeup being a real estate, real asset play as well as the technology team is really key here, and really interesting, because there are far more moving dynamics in the asset than there would be in a pure play real estate asset, or a pure play infrastructure. So the experience piece is key, and I think something we just see generally, family offices talk about is they don't necessarily have the same bandwidth, framework, skill set in their investment team, dependent on their size. They don't have the benefits of the analysts that Maria would have in her team, so they rely much more on I guess promoters and managers that have got direct experience and a team around them, which is slightly different to the institutional investor space. So following on from that, one of the questions I think would probably be about entry into the market. How would the family offices enter the market? Maria's talking about effectively a fund-of-fund play, or investing in a fund. Then there's like the co-invest secondary piece. What are you? You both come from slightly different positions. So what are you seeing at the moment, Maria? How do you as a team, are you investing purely in the fund space, or are you taking kind of co-invest and direct as well?
Yeah, no, not at all. I mean, we really, from the bottom up and then since inception, really try to make sure that we could take, also an exposure to the segment, specifically also digital, through investments and now more secondaries. Okay. Because we do have the DNA within the organization, and secondly, because we do want to offer to our our balance sheet, but also our broader institutional base, kind of a very steered portfolio wherever we see those themes that are attractive for us. So to your point, how can you get into the space? I mean, clearly you can do it through a fund. You can also do it through co-invest. But no, we now see even dedicated to data centers, co-investment or continuation vehicles, that are also an option to get in, and of course direct deals, but maybe less relevant potentially for family offices, depending on the tickets that they want to to invest here. But what I see is, what is actually your goal? That's how I would define it. Are you trying to get, quick deployment, quick kind of exposure to the space? Then it is more going into a co-investment, going into a GP-led secondary, maybe that would get you that even subsector allocation that you're looking for. If you're maybe one step before, you're trying to kind of just grow more organically your allocation to digital, then it is about those digital infrastructure funds in the market, such as Marix, and maybe also kind of a broader portfolio. It doesn't have to be just data centers. It doesn't just have to be one geography. I think it is how maybe what existing exposure you already have to digital, and then what you're trying to.
Yeah. And Mark, you were saying, just before, the sort of genesis of you and your partner and the firm was with the family offices, who I assume came and as cornerstones or investors into your fund structure. Have you seen them sort of migrating into a sort of, as Maria's talks about, some co-invest and direct investment alongside, or are they really following you in the fund regime?
I would say because of the early vintage of some of the investments that we did back in 2013, 14, and 15, all of those early investments at DigitalBridge have now printed and have returned all the capital back. So they've had the experience of making, anywhere from 2 to 4 times MOIC with us in cell towers and in data centers predominantly. As Maria said, it's not just data centers. So we've had 2 really successful exits in cell towers that had a 13 and 14 vintage. And then we had data center vintages in 15 and 16, DataBank and Vantage. Those early continuation funds have fully exited. And so those had really good prints and full DPI for all our family offices, which was great. And so ultimately we sat down with some of those clients and said, okay, where can we put your capital back to work? And you'd be surprised, most of them really like co-investments. They really like the ability to be singularly focused on a management team and an opportunity, the big family offices, the sophisticated ones. And so, we've continued to work with those family offices. We've put them into great platforms, whether it's recently having closed a significant co-invest vehicle for a business called Ames out of Kuala Lumpur, which is an edge data center business in Southeast Asia. A lot of people don't talk about edge compute, but that's a really great business that's growing at like 35% CAGR. And we did a $320 million co-invest round, and there was probably $80 million of family office money that was predominantly Asia family office money. And then we did a co-investment round for Switch about 1.5 years ago, and that was roughly a couple $100 million of family office money. And Switch is a great private cloud operator, tier 5, highly secure, based in the US. And so we've become very product differentiated. Not all data centers are the same. They're actually quite different. There's a lot of different business models in data centers, whether it's edge computing, private cloud, large hyperscale campuses for public cloud and LLMs. And I even think there's one business we're working on, which is a micro edge business, which is small data centers that are more peripheral to cell towers, where ultimately inferencing is going to happen. So we're spending a lot of time thinking about edge to inferencing. What does that look like? Machine to machine learning. How do you put compute closer to traffic signals? How do you put compute near AI factories, autonomous vehicles? There's a whole wave of digital infra 2.0 coming, which really involves, slightly modified data centers that are smaller and more agile and more edge-based. So again, it's such a big expanse, right? There's so many different ways you can play in AI infrastructure. And eventually, as we turn on the first AI factory here in the US in about 18 months, you're going to start hearing a lot about AI factories. And AI factories is absolute, industrial use cases of AI, which is infrastructure tethered to robotics and industrial outcomes. So a lot coming. There's a lot more compute coming, and there's a lot more investment coming. And that'll be interesting, taking sort of industrial factories and AI and data centers and pushing them together into a new economic model that will be infrastructure. It'll just be digital infrastructure 2.0.
Okay. I think following on from that, and you both live and breathe digital infrastructure and the the thought process, or the reality around that. But there's a lot of publicity in the press around and to discuss around the ESG elements of AI, the negative perhaps perceived negative connotations related to AI, drained on power, etc., of this space. How do you incorporate kind of ESG in your, especially for an institutional investor like yourselves, where ESG is really core to sort of overall thesis of an organization like yours, Maria? How do you balance this ESG piece in digital infrastructure, and is it a key consideration?
Absolutely. It is because of our, I guess, insurance, Allianz group heritage, but also our institutional investors here in the region is absolutely critical. And there's two ways we think about this and incorporate that in our investment decision. One would be, of course, kind of the underwriting of the platform or the fund that we're supporting. Like it is, looking at KPIs such as, share of renewable energy in the different portfolio companies, data centers specifically, that they're supporting. How is that? Is that through credits? Is that through long-term PPAs? Is that through like maybe a JV with actually like some energy generation companies? I think that is kind of like something we want to see, and also see some ambition in terms of what's going to happen. Where are you starting, but where do you want to be when this exits? Because this is not getting, at least for the institutional investors behind us, not getting less important. And the second point is around data availability, which is really also critical for us. At the end of the day, of course, you want to see those commitments, you want to see that in the business plan, but you also want to make sure that you can reflect that. I assume it's the same case for family office, ultimately in the footprint and the carbon footprint of your portfolios. So in order to be able to do that, then you need to get access to that data, right? So what is maybe around, carbon footprint specifically, data around scope 1, scope 2, scope 3 emissions. How frequently are those delivered? Are those delivered at the level of the fund, or do you getting them at the level of the portfolio company? So actually there's a lot of maybe data crunching and availability that is quite important for us, so that we can actually deliver, and be able to show on a portfolio level, at our level, what are, what type of platforms ultimately we're supporting, and how we're actually, really trying to move the needle on the ESG side.
Yeah, and I think, I'm going to turn the same question to you, Mark, because you're going to come in from a slightly different perspective, because we see, generally we see ESG as a factor for investors, as Maria's talked about, in terms of fundraising and investment strategy. But there's also the asset level issues and asset reporting, etc. How do you deal with that?
Well, we've been publishing for 6 years now an annual ESG report. Maria gets a copy of it every year, so hopefully we do a good job of that, putting the metrics. Maria's correct. It's about the data. I mean, a lot of people do this. They just talk. Like, it's not about talking, it's about doing. And so what we do is we report, at the portfolio company level, in terms of our march towards being carbon neutral by 2030. We haven't, a lot of US companies have walked that back. We haven't. We've stayed true to that because we just think it's implicitly the right thing to do. We have to do it. It's not even the right thing to do anymore. It's sort of table stakes for the planet. And so we've made an aggressive move with a lot of our data center businesses. We've got, 3 of our 11 different platform investments now are 100% carbon neutral, which is great. We look at, a business like Scala, for example, is one of our great standout companies in Brazil. It is 100% powered by green energy now. It's all hydro. We built 2 microgrids. We lease our own transmission infrastructure. We bring that power, down into Sao Paulo, into Campinas, and we've done an amazing job creating 800 megawatts of, renewable power. And we're only using 360 megawatts of that power, in our 14 data centers. So we sell power to our competitors. We sell power to Equinix, to Digital Realty. We sell power back into the Sao Paulo grid. And so, having that sort of acknowledgement of being not only just trying to go green, but also to put that power back into other competitors' data centers so that we can help, we think is actually critical. We make a profit on that, but the key is, we want to be minded towards making sure that we can be a good corporate citizen as well. Switch is a great example that Maria knows Switch quite well out of Las Vegas. Switch has been 100% renewable for a decade now. And the CEO there just had a set of founding principles that he wanted to make sure that he didn't have a negative carbon footprint in terms of what he was doing with his business. So we've continued to do that at Switch, and we're doing it at DataBank now is almost 100% renewable now. And it takes hard work. And you've got to stay after it, and you can't let political pressure, unwind what you've committed to. That's super important. And in addition to that, we're also super focused on water. We're starting to report water metrics. This will be the first year that we report how much water loss we have in our data centers. We're super focused. Again, Switch is one of the leaders in this. We don't lose a drop of water with our new cooling system called Evo. It's a completely self-contained system, which a lot of the customers like NVIDIA and CoreWeave and Google really like, because they're not wasting water. All that water stays inside of the data center. It's a self-contained system. So highly efficient. And most importantly, the cooling is actually better when you go to liquid cooling. So these are the things that we're focused on: power, cooling, water. These are the metrics that we should be tracking. And we take feedback from our LPs, like Maria and other LPs, that tell us what we'd like to see. This is how we'd like to see it reported. And so it's an ongoing, dialogue. I don't think it's a one-way street. I think we solicit a lot of feedback from our partners, and they give us that feedback. We modify and we change.
Okay, I think
and it's evolving, right? I think that's a reflection of what Mark is saying. It doesn't really, there is actually movement around, what is expected under SFDR, what is expected under EU taxonomy, and that really evolves over time, and hence also what GPs deliver does need to evolve over time.
Yeah, and I think it's tricky because obviously, there's those changes, and then the needs of specific investors, LPs, differ as well. What they need to report internally is quite far-reaching. So from a GP perspective, I know it's tricky to sort of capture everything that everybody wants and create a fair balance of that. Mark, you've referred in a couple of examples about a pretty far-reaching geographical spread of the investments you've made. We've just talked about Brazil, we've talked about Asia. How does geography, and therefore the ever-changing regulatory landscapes in those geographies, which are changing, coming right back to the investment strategy about, you can't forward plan for what an individual government's going to do around power usage, etc. How does geography play out in your investment thesis and selection of assets? I suppose for both of you. Maybe start with Mark and then see how it plays out from an investor perspective.
Mm-hmm.
From an investor
I think,
perspective.
From an asset allocation perspective, we're always retesting every fund on geography. And so what we've done from our first flagship fund to our second flagship fund to our third flagship fund has been very different, actually. Good. So, in Fund 1, for example, we were risk on Latin America. In Fund 2, we were risk off on Latin America and did one investment there. And in Fund 3, we don't even have an allocation for Latin America. We've moved that allocation into Southeast Asia. Emerging markets are really complicated. Maria knows this all too well at Allianz. They have a portion of their portfolio that goes into emerging markets, and it's a tricky decision you have to make on where you're going to go. And we look at dollar strength. We look at, of course, the political environment. We look at the zoning environment. We look at the power environment. All of these things weigh in our decision making in terms of whether we're going to Malaysia, whether we're going to Brazil, whether we're going to go to Colombia, or whether we're going to go to the Philippines. I mean, these are decisions you take, and a lot of that has to do with political stability, regulatory, and the quality of the currency exchange. And so we think a lot about that, and we're constantly retesting that. So right now for us, we're sort of risk on Southeast Asia, and we're risk off on Latin America, by example. We're starting to warm up to the idea that we're going to come back to Latin America in the next 2 to 3 years. But just given the sort of political environment in this hemisphere, between how this current administration thinks about the South versus other administrations, we just have enough information that we say it's not a good bet for us today. Mm-hmm. Where if we look at a market like Southeast Asia that has all the growth metrics we're looking at in terms of 5G adaptation, AI adaptation, mobile penetration, minutes of use, all the metrics that define how much digital infrastructure is growing, the most exciting marketplace in the world today for us is Southeast Asia by far. So that's where you see us investing in fiber networks, cell towers, edge compute, hyperscale campuses. But when you see a growth market like that coming, there's also the flip side of that, which is power, as you said. So look at, for example, Johor. Johor is a small city that's adjacent to Singapore, sits across the river, in Malaysia, and it's a fantastic data center market. But it got to almost 2 gigawatts within 3 years, and so we played a role in that. We have 400 megawatts of that, almost 2 gigawatts, and now the Johor government has shut down all new data centers. So that can happen. You can get into a market like Malaysia, and the political winds can shift very quickly in terms of where people want power and how they're going to do it. The factor there is they just ran out of power. They don't have enough power to power the data centers. So now we're looking at turbines, we're looking at LNG, we're looking at battery storage capabilities, solar, but we still like the market, but unfortunately the power kind of turned off there on us. So you got to keep your eye on that, which is a great example for why in Brazil we went with 100% hydro. The grid in Sao Paulo was really unstable, and we looked at that and we factored that into our decision when we built some of those big hyperscale campuses, in Campinas and in Sao Paulo City.
So I think, I guess.
And I would add that.
Sorry, please go, Maria. Yes.
Yeah, no, I would just add maybe on what we also look at how do you think about exactly the political background or regulatory framework in those jurisdictions, is building it again from a portfolio level view on like what type of exposure, where can you actually take maybe a limited risk, and we really are conservative in that regard in terms of going into those markets. And of course, as Mark said, whether right now your view is it on Asia, is it on Latin America, but more broadly, I think for us, a topic we do make sure is looking at the underlying cash flow, FX exposure that you have. Effectively, you're talking about dollar exposure. If you're even in emerging market, are you taking local currency risk? Are you able to hedge that even at the level of your portfolio, or is the GP that you're working with hedging that at their level? So there's definitely kind of the FX overlay that is also quite relevant for us.
Sure.
Ultimately, it can play a big role in terms of the return that you get.
I mean, using listening to Mark's example there about change of jurisdictional appeal quite quickly. It sounds to me like diversification of jurisdiction and assets, is quite key in this space, because of change of, if something can change that quickly, it has direct impact, especially if you're only into one asset or you're in a single asset. So, can we just quickly sort of talk, or as we bring this kind of general conversation to a close, can we talk quickly about valuations? What you've seen in the market, how there is a lot of, I'm going to use the word hype, apologies, but there is a lot of talk about, let's be honest, digital infrastructure, AI generally, right? How are you seeing valuations of assets in light of all these kind of comments we've just made about jurisdictional changes or regulatory changes? How are they flowing through? What do you see the future in the medium to short term for this asset class? Perhaps start with you, Maria.
Yep. Yeah, no, I think undeniably we've seen some of the valuations rise. I think multiples, that we've seen, like entry multiples for some of the platforms, in the market that we've seen really, going into beyond the 20 times entry multiple, but really going significantly above what precedent transactions or just where we've seen the market just only 2-3 years ago. We've seen also some switch into preferred type of structure, so some transactions that don't come in with just traditional equity, but really try to build in some coupon downside protection, which we also think it's maybe a way to kind of try to manage this apparent increase in entry valuations. But ultimately, how do we think about it? When we're trying to assess, is that the only lever that we're focusing on? No, we really also look into, what type of what portion of the entire pipeline or land bank that this platform has are we ultimately underwriting? How much just have access or have near-term access to power? And how much do we need to believe in that is really coming from cloud, which maybe is kind of like the base kind of support that you of course need to have in your business case, but how much is coming from AI? Like how much AI growth do you need to believe in those regions where maybe you might take a different view to what a GP presents you. And ultimately, I think we discussed it before, just what exit assumptions are you talking here? And they can really vary. There's markets where there's like Singapore, where there's one maybe cap rates at 5 or so are potentially acceptable, but there's other jurisdictions of the rest of the world where you're really seeing something more like 6 to 8% being kind of the right approach here. So it really does depend a little bit on what the platform and the region that you're looking at is focusing on.
Okay. And Mark, from your perspective, obviously working on large number of transactions as well as managing the funds, as any fund manager, balancing assets and the valuation is always a skill and a complication for investors. So how have you seen that sort of play out over the last couple of years, or last few years?
Look, I think I get maybe perhaps I'm a bit more sanguine about this because I've been doing it for 30 years. So I've watched towers go as high as 35 times, and I've watched towers trade coming out of the dot-com era as low as 11 to 12 times. And we've seen fiber businesses, resi fiber in the peak of COVID, Maria, trade at 25 times. European residential fiber trade at 25 times, and now those businesses are bankrupt. And we've seen fiber assets trade at 4 times. We just bought a great business in the Midwest. We took private for 4.3 times. We're buying Crown Castle's fiber business inside one of our platforms for 4.6 times. So you have this massive chasm, right, in valuation. And really, it's in the eye of the beholder. If somebody wants to pay 25 times, they're going to pay 25 times. If somebody is sophisticated and understands that these things are quite cyclical, you'd certainly like to be on the 4 times trade, right, as a buyer. And I've been really fortunate. I've sold businesses for 30 plus times, and I've sold some businesses for 13 to 14 times. But it really is about timing, right? And it's about having a sense of when people want to invest. But a lot that is not spoken about in digital infrastructure and GP land today is the importance of strategics. Strategics are critical when you go to sell a business. So when we go to divest of a company, we want to make sure that that particular swim lane, whether it's fiber, data centers, tower, whatever it is, the presence of a strategic bidder in a process really helps a process enormously. We're in the middle of selling a business right now in Europe. We're selling a fiber business, and it's coming down to selling to two strategics. And this is the first time that we've had, in the last, probably Maria, in the last 5 or 6 years, where we've run a process and we have 2 strategics running hard all the way to the end, which is great because they can justify paying a higher price because they're taking the cost out, right? So they're really truly looking at the NOI contribution. They're not looking at the EBITDA contribution. So the multiple that we're getting for this business makes no sense at all. It would not be something that another private equity firm would do. A GP wouldn't do this deal. And so the return of strategics and having the right rate environment and having them at the table in a process is really critical, because where we've sold for the best prices is when we sell to strategics because they can justify the synergies involved. That being said, we've exited a bunch of other ways. We've exited through continuation funds. We've done partial recapitalizations. We've done IPOs. I think you just have to be very creative, and you have to also have a pulse, a sense of kind of where strategics are and where capital markets are.
Okay. So I think we've definitely reached our cutoff time. So if I were to maybe I'm going to make a couple of kind of closing summaries from my perspective. I've learned a lot today, and obviously I generically represent families across a whole broad range of investment strategies, and this is clearly for everyone who's listening today. It's an evolving space. all the time. We've talked about governmental changes, we've talked about technology changes. Maria's talking about, clearly about ESG themes. I think really working with counterparties that understand this space. Mark's just sort of made his closing comments about like 5 distinct strategies. So, for a family office to really start to build a framework and investment strategy around this space, working with key partners, working alongside investors like Maria who have capacity and team to invest on scale and understand the asset class, I think is really key, far more than many other types of investments that families make. Can I just say to both of you, thank you so much for taking the time. I know, Mark, it's early in the morning for you, and Maria, thank you to you both for taking the time. Thank you to the Private Markets Group for bringing us together, forming part of the Digital Family Office Forum today. From my side, it's been great to participate, and especially to do this with 2 very knowledgeable panelists. So thank you all. Hope you all have an enjoyable rest of the forum, and thank you both. Have a lovely day.